I am AI avatar of CA Ratan Mundra. The Reserve Bank of India has introduced a major clarification that significantly impacts the NBFC sector. The RBI has rejected the industry's proposal to narrow the definition of public funds. Instead, it has taken a broader and stricter stance. According to RBI, any funds sourced from outside, whether directly or indirectly, must be treated as public funds. This includes borrowings routed through group entities. This clarification removes ambiguity and closes potential loopholes. While this increases compliance requirements, it also brings clarity to the regulatory framework. In this video, we will break down what has changed, who is affected, and what actions NBFCs must take immediately. The RBI has introduced a relief framework, but only for a very specific category of NBFCs. To qualify, an entity must meet three strict conditions. First, it must not have any public funds. Second, it must not have any customer interface, meaning it should not engage in lending or financial services to external parties. Third, its asset size must remain below 1,000 crore rupees. Only such NBFCs may be eligible to operate without registration under certain provisions. However, this relief is not automatic. Entities must carefully evaluate their structure and apply through the RBI's PRABA portal within the prescribed timeline. The RBI has clearly defined what constitutes public funds. This includes bank loans, intercorporate deposits, debentures, and commercial papers. However, the most critical addition is indirect funding. If an NBFC receives funds from a group company and that group company has borrowed from banks or markets, those funds will also be treated as public funds. This concept is based on the principle of fund fungibility. Once money enters a group structure, it becomes difficult to separate owned funds from borrowed funds. Therefore, RBI considers the entire chain of funding, not just the immediate source. The NBFC industry had proposed several relaxations, but RBI rejected them. One major request was to exclude loans from promoters, directors, and shareholders from the definition of public funds. RBI declined this, stating that such funds may still originate from borrowed sources. Similarly, the idea that equity investments into group companies should not count as indirect funding was also rejected. RBI emphasized that in complex group structures, it is nearly impossible to track the original source of funds. Therefore, all such arrangements will be treated conservatively as public funds. The RBI has also clarified the concept of customer interface. Even if an NBFC deals only with promoters, directors, or related parties, it may still be considered as having customer interface. The regulator has taken a borrower-neutral approach. This means that the nature of the borrower does not eliminate regulatory obligations. Whether the borrower is a third party or a related entity, the activity itself may trigger compliance requirements. This is a significant shift because many NBFCs previously assumed that internal group transactions were outside regulatory scrutiny. For genuinely passive NBFCs, the new framework offers meaningful relief. Entities that meet all eligibility criteria may not be required to maintain registration under certain sections of the RBI Act. This reduces compliance costs and administrative burden. However, this does not mean complete freedom. RBI retains its supervisory powers and can intervene if risks arise. These entities must continue to maintain transparency, proper documentation, and compliance discipline. Therefore, while the relief is beneficial, it comes with ongoing responsibilities. The biggest impact of this clarification will be on corporate group structures. Many groups used layered entities to route funds and maintain a no public fund status. This is no longer possible. RBI will now examine the entire group structure and funding chain. Companies must prepare detailed fund flow statements showing the source and movement of funds. This eliminates regulatory arbitrage and ensures transparency. Groups must now adopt a holistic approach to compliance rather than focusing only on individual entities. The most important change in this framework is the explicit inclusion of indirect public funds. Earlier, there was ambiguity regarding funds routed through group entities. Now, RBI has clearly stated that such funds will be treated as public funds. This prevents companies from bypassing regulations by using intermediary entities. The new framework strengthens the regulatory environment and aligns it with global standards. It ensures that NBFCs operate with transparency and accountability. NBFCs must take immediate action to comply with the new framework. The first step is to map all funding sources, including indirect flows. Next, they must review all transactions to identify any customer interface exposure. Finally, they must prepare proper documentation, including board resolutions, auditor certificates, and disclosures. Entities that qualify for exemption should apply for deregistration within the specified timeline. Those that do not qualify must plan their future strategy, including possible registration as higher category NBFCs. Globally, financial centers like the IFSC, ADGM, and Singapore offer light touch structures for passive entities such as SPVs and family offices. However, these structures do not allow active financial services without licensing. Similarly, India's IFSC framework currently requires registration for finance companies. A similar light touch model may be introduced in the future, but it will likely include strict conditions. The key takeaway is that while regulatory flexibility is possible, it will always be balanced with strong oversight to prevent misuse. Moon says, and Management Consultants LLP, a trusted partner for SEZ and IFSC Excellence, a pioneer in establishing and IFSC units within GIFT City and India, delivering end-to-end IFSC setup, operational support and handling compliances, risk management, renowned for deep expertise in regulatory approvals, capital markets, fund management, insurance, finance company, foreign university, BATF and ancillary regulations, and fintech expertise in customs clearance for aircraft and ship procurement, leasing, GST, DSPF, IFSCA. Comprehensive support covering registration, reporting, and regulatory transitions, ensuring ring fencing, transparency, and global compliance standards. Join our network, scan the QR codes below to stay connected with us.